There are tons of different creative retirement withdrawal strategies out there, but very few of them are actually intentionally designed to meet an individual's retirement goals. In today's video, we're going to be ranking some of the most popular withdrawal strategies based on their risk, their ease of application, and a range of other factors. I'm a certified financial planner, and I'm the owner of an independent financial planning firm, and the withdrawal strategy decision-making process I'm going to run through in this video today has helped retirees achieve a wide range of flexible retirement goals. So how do you choose between traditional withdrawal strategies such as the 4% rule or more flexible approaches like the 3-bucket strategy? Committing to a strategy that meets your retirement goals over a 5, 10, or even 15-year time frame can actually be very daunting. It's a huge commitment. And on top of that, several of the most common withdrawal strategies that are actually suboptimal for retirees. And this topic is so fascinating to me because it's one of those areas in life that really highlights the gap between practical reality and academics. So, what is a retirement withdrawal strategy? A withdrawal strategy details how you would take income from your investments each year. An effective withdrawal strategy can actually preserve the longevity of your retirement savings. It can also increase how much you can spend in retirement safely, and it can structure that spending so it's done at the optimal ages in retirement. And cleverly crafted, it can even help you with all three of those elements. And so a quick note here, I'm going to start by explaining 4 different withdrawal strategies in this video. Once I've explained each strategy, I'm going to explain the criteria I used to test in order to rank each strategy. And then finally, I'm going to share the ranking themselves. So you're going to want to stay tuned for the back half of this video if you want to see the actual rankings themselves. And because I can only include so much information in one video, I'm not going to be able to cover how saving strategies actually impact which withdrawal strategy to use, but I'm going to be releasing a video soon that will break down the retirement saving paradox in more detail. So be sure to subscribe to the channel so that you won't miss that video. Okay. The first strategy is called a Prata strategy. I'm going to pull it up on the screen here. We're going to show some animations and visuals. I actually call this the I take what I need strategy. And so in practice, what you do is you start year 1 of retirement with a set asset allocation. Say a 40% bond, 60% stock allocation. Each year, you distribute the income you need in order to live on. And at the end of each year, if your asset allocation has shifted because of the money you've drawn out, or due to market performance, you rebalance your investments back to a 60% stock, 40% bond allocation. And you do this each year in retirement, repeating the exact same process each year. It's a very simple method. And your investment allocation will actually look like this straight line chart that I'm showing here with the blue, the green, and the orange, because each year you're actually rebalancing your allocation straight back to where it started, and so you see no deviation in your asset allocation over time. The second strategy we're going to go over now on the screen here is what's called the 4% rule. Executing the 4% rule is actually often quite different from what people think it is. So in order to execute it properly, you would need to start retirement with a 50% stock, 50% bond portfolio. You would then take your starting portfolio balance on day 1 of retirement. On the screen here, say that is $1 million. And then what you would do is you would multiply that $1 million by 4%, which results in a $40,000 first year income. Then each year from there, you draw $40,000 adjusted for inflation. And so as you can see on the screen here, year 1's income is $40,000, year 2's income is $41,200, year 3, $42,436. And you can see each year it's based off of that year 1 income, right? And then each year, at the end of each year, based on market performance, you would also, like the pro rata strategy, need to rebalance your portfolio asset allocation back to the starting portfolio allocation, which is a 50% stock, 50% bond portfolio. And as I've already said, this is actually quite different from what most prospects and clients I speak to think the 4% rule requires. Most people think that you actually take 4% of your portfolio every year, meaning that if in year 1, the portfolio is $1 million, you take $40,000. In year 2, if the portfolio grew to $1.2 million, you would take $48,000. And in year 3, if it has shrunk to $900,000, you would take a $36,000 income. And that is actually not the case. It looks like what I'm showing you on the screen here, which is you use your starting year 1 income and then inflation adjust it for 30 years. And that's how the 4% rule works. Now, there's a second place people go wrong with the 4% rule, which is that they don't realize that what they actually have to do in order to achieve what it sets out to achieve, which is to have a 100% likelihood of not running out of money over a 30-year retirement, you also need to start with a 50% stock, 50% bond investment allocation and rebalance it back to that 50-50 allocation each year. The third strategy we're going to review is called a glide path. A glide path strategy functions very similar to the Prata strategy, which we talked about first, with one small tweak. Essentially what happens is you start retirement in year one with an asset allocation, say 60% stock, 40% bond. And as a way to manage risk as you age, you would reduce your stock exposure by 1% per year and replace it with bond exposure by 1% per year. So in effect, in year one, you might have a 60-40 portfolio. In year two, you have a 59 stock, 41 bond portfolio. In year 10, you have a 50% stock, 50% bond portfolio. And by year 30, you have arrived at a 30% stock, 70% bond portfolio. And in this scenario, each year, you take out the income you need to live on. And at the end of the year, you rebalance your portfolio back to the asset allocation indicated based on what year of retirement you are in. And this would be most similar to a target date fund strategy, which is very common in 401ks and other retirement plans. A target date fund is actually a fund that operates based on a glide path. It essentially reduces stock exposure sequentially as you age and replaces it with bond exposure. The fourth item we're going to evaluate here is what's called a guardrail strategy. Now, unlike the other strategies, the guardrail strategy will actually tell you how much you can spend in any given year based on your portfolio value at the beginning of that year. When you hit a lower guardrail because your portfolio has decreased in value, a spending cut would be triggered. And when you hit the upper guardrail due to portfolio growth, a spending increase would be triggered. And for as long as your portfolio value stays between the two guardrails, you would have no change in income other than an inflation adjustment each year that the portfolio remains between the two guardrails. So in the example on the screen here, if you start with a $1 million portfolio and you want to have an 80% chance of underspending and a 20% chance of overspending, this would be most similar to an 80% probability of success in Monte Carlo. Your upper guardrail would be $1,058,000 and your lower guardrail would be roughly $662,000. So when you hit the upper guardrail, you get a spending increase of roughly 5%. That would result in a spending increase from $67.62 per month to $71.60 per month. And if you hit the lower guardrail, you get a spending decrease of roughly 5% as well, which would result in a decrease from $67.62 per month to $64.24 per month. So now we have the 4 common withdrawal strategies outlined. Let's talk about how we would measure and rank them. So I'm going to use 2 different categories of measurements: quantitative, which are numbers, and qualitative. Quantitative are the numbers, and we want to know specifically how to measure the financial improvement or impact of the withdrawal strategy in question. Now, qualitative are non-financial measures that tell us how likely we are to be able to stick to a strategy. See, most of the time we forget the qualitative measurements. They're incredibly important because a mediocre plan that you can execute consistently over time is way better than the perfect plan that you eventually abandon due to difficulty or complexity. And the best analogy for this would be a health plan. The science on the health is in. If you want to lose weight, you have to maintain calorie balance. You have to eat less or move more. We know the science. Yet the reason people have such struggles sticking to a health plan is because we give someone the perfect health plan that tells them how they're scientifically going to lose weight, but it's so difficult for them to actually execute, or it requires so many sacrifices and trade-offs that they can't stick to it over time. So the far better health plan is to actually give someone something that they can do, even if it's mediocre, but they can do it for 30 years. So let's dive into the quantitative measures as it relates to withdrawal strategies first. You can see there are 5 quantitative measures that we're going to talk through. The first is portfolio spending in the first 10 years of retirement. I favor this as a quantitative factor because what it does is it tells us, if you use this withdrawal strategy, how much spending are you going to have to sacrifice in the first 10 years of retirement while you are youngest and most probably desiring to spend that money. The second measurement we're going to use is what's called median retirement assets at year 11. So effectively what that is it's a carry-on. We want to know, if you spend more or less in the first 10 years of retirement, what impact does that have on the median portfolio at the end of that 10-year period, right? What trade-off or sacrifice do you have to make? Then we want to look at total portfolio spending in retirement. Which of these strategies actually gives you the most spending in retirement? Then the fourth item we're going to look at is the median end of period retirement assets. So which of these strategies gives you the biggest end-of-life portfolio at the end of your retirement plan? And then finally, we're going to look at probability of success. Monte Carlo score. And I've actually ranked these in order of preference because I actually find that probability of success, while a useful tool, is actually not very reliable. There's a lot of confounding factors, and I've done other videos on this, but it can be helpful. So these are ranked in order of what I believe to be the most impactful and useful measurements. So let's talk through the ranking system, or the scoring for each strategy. So I'm going to roll those out on the screen here. Now you can see that the grid here is filled in based on each withdrawal strategy we've talked about so far in this video. And I've color-coded it so that you have in green the winners of the category, and in red, the loser of any given category. So we're only going to really focus on the winners and losers because there's not enough time in this video to go into exact detail about everything, but I'm going to highlight the salient points before we move to the qualitative factors. So in this scenario, you can see that the winner of the first 10-year spending objective is the Guardrail Strategy. You get to spend $770,000 off the same starting portfolio, which is roughly $1 million. And the 4% rule is the loser here. And that makes sense because the 4% rule is effectively telling you if you want a 100% probability of success, you're going to have to sacrifice spending when you're young and allow inflation to grow that spending capability over time. And so it makes total sense that you're going to have the lowest spending from the 4% rule. Now, inflation adjusted and glide path falls somewhere in between. And the reason I'm not going to spend a lot of time on these particular strategies, even though they are extremely commonly used, probably the most commonly used withdrawal strategies across the United States, there are some really big problems with them that make it so that the numbers are not exactly trustworthy for the inflation adjusted pro rata or glide path strategies. The winner of the second quality here, median retirement assets at year 11, also makes a lot of sense. The Guardrail Strategy, because you spent almost 5 times as much money in the first 10 years of retirement, is going to have a lower portfolio value. You've taxed the portfolio more aggressively. And the 4% rule also inversely is going to have the highest 11th year portfolio value because you've effectively not taken almost any money out of it in comparison, right? And you can see that in the balances shown on the screen here. You have an 11-year portfolio value of $1,500,000 roughly in the 4% rule and $993,000 in the Guardrail Strategy. When we move down further, when we look at total spending across retirement, the same numbers play out. The 4% rule has by far the lowest spendable money across all 4 of these strategies, and the Guardrails has the highest spendable money. Now, glide path and pro rata both have higher values or very near to the Guardrail value. The reason they're not winners is because the probability of success and the median end of plan assets are so low. And the reason that that matters is because what that says is when you use a pro rata only strategy or a glide path only strategy, in this scenario, you're very unlikely to actually survive your retirement and have assets left over. In fact, you're very likely to spend them down fully before you actually pass, which means that total portfolio spending in retirement doesn't matter in the pro rata or glide path strategy because it only matters if you can actually get there, right? So we don't want to know how much someone could have spent in the best scenario in the, 1 out of, the 40 out of 100 scenarios that worked. We want strategies that are more reliable. And so we award the victory in this category to the Guardrail Strategy. Now we can go through the last 2. Median end of period retirement assets, the 4% rule once again wins. It will leave your heirs the largest legacy. Obviously, the trade-off for that is you get the lowest spending while alive, right? So that's natural, logical trade-off. If you want to spend more while you're alive, you're going to have to sacrifice legacy. If you want legacy, you're going to have to sacrifice spending. Guardrails is kind of in the middle. You end up with a pretty modest but sizable legacy pool of assets in the median scenario, and you do so while also getting a lot of present day or early life spending. And then we end with the probability of success here, and you can see that pro rata and glide path absolutely suck. They're in the low 40s or mid 40s. That is not sustainable. With the 4% rule, you get an 100% probability of success with Monte Carlo, and in the scenario we've outlined here with Guardrails, you get an 80% probability of success. So effectively, with the Guardrail Strategy, you're making a modest sacrifice in terms of probability of success and end-of-life assets to have significantly more present-day or early retirement spending where your time value of money is actually a lot more meaningful. That is the quantitative side. Now let's look at the qualitative side. Again, we're going to talk through the 4 metrics we use to track here, and then we're going to unroll the grid for you to see, okay? We're ranking this on 4 metrics. Peace of mind. Peace of mind is very important because that's essentially confidence. How confident are you or how anxious are you about your withdrawal strategy? Because most retirement plans blow up because someone gets nervous and then makes an impulsive action and can't stick to the plan, right? So peace of mind is very important. The second one is ease of execution, right? How easy is this to execute? As I alluded to before with the health analogy, if you give someone a plan that's simply too difficult to execute, you can't expect them to do so and you can't expect them to stick to it. And so we're going to rank these 4 strategies on ease of execution. Then we're we're going to rank them on proactive versus reactive. A helpful way to think about proactivity versus reactivity is how many at-bats do you get to adjust or course correct using the given withdrawal strategy. The more at-bats or course correction opportunities you have, the better the strategy. The less or fewer at-bats or course correction opportunities, the worse the strategy. And then finally, income stability. How reliably can you expect a stable, guaranteed, predictable income over the course of your retirement if you use this strategy? Okay, now we're going to unroll the grid here, and we're going to go through again the winners and losers, winners highlighted in green, losers highlighted in red. So, peace of mind. Which of these plans will give someone the most confidence? This is a pretty shoehorn answer. The 4% rule is going to give you the most confidence because the research and academic data is in, and it shows that in 100% of scenarios across all types of market performance, if you follow that rule and you do it right, you will end up with 100% probability of ending life with money and not running out of your assets. The trade-off on the other side, or the inverse of that, is the pro rata or inflation adjusted model, and that one will have terrible peace of mind. And the problem is it's because it's I take what I need or I take what I want, meaning you don't have rules in place for how much you can support or how much income you can support each year, and therefore you're going to have a tremendous amount of anxiety because you don't actually know how long your portfolio is going to last based on that strategy. And then the guardrails falls a lot closer to the 4% rule, and the glide path also falls a lot closer to the pro rata, right? The second measure here, the winner of ease of execution, is actually the pro rata method or the inflation adjusted scenario. And that's because the trade-off for the fact that you don't have a lot of peace of mind is that it's very easy to execute. It's the simplest of these withdrawal strategies to execute. You require almost no action other than take money out, rebalance portfolio once a year, wham, bam, thank you, ma'am, it's done, right? It's so simple. Now, the trade-off for that obviously is you're going to have more anxiety. With simplicity comes more uncertainty. And the 4% rule shows that inversion or that trade-off completely, right? You get a 10 out of 10 on peace of mind, but you get a 1 out of 10 on ease of execution. And the reason that it's so difficult to execute the 4% rule is because it's the perfect plan. It is so difficult to execute because the odds or probability of you living your life and being able to take a fixed income that is only inflation adjusted for inflation every year with no deviations are actually statistically zero, in my opinion. That is simply not the way humans behave. The odds of you never having a financial emergency, never having a health emergency, never having a housing emergency or a kid's emergency are so low that the 4% rule, in my opinion, really can't be executed in reality. And the guardrail and glide path are slightly better. Glide path has an 8 out of 10 in ease of execution. Again, you're trading a simple strategy, but you're going to give up peace of mind, where the guardrail has a better balance of those two. For proactive versus reactive, our third element here, you'll see that the winner is the guardrail here. The guardrail strategy actually gives you at-bats very frequently to course correct because what's happening is you're given a set of rules that tell you if your portfolio value triggers this guardrail, change your income to this dollar amount. And it's very specific, it's predefined, you can know it in advance and plan for it in advance, and you're going to receive many of those opportunities over the course of your retirement. And many of those opportunities will be increases in spending as well, right? It won't always be decreases in spending in the guardrail strategy. Actually, statistically, it's much more often that it is an increase in spending than a decrease. And the inverse of this is going to be the inflation adjusted or pro rata strategy. Very, very reactive. You don't do any proactive adjustments to portfolio or spending in this strategy. You simply spend what you need and rebalance your portfolio at the end of the year reactively with no regard for how the market is performed that year, how it will perform, or with no regard based on how you spent and how that's taxed the actual portfolio. And finally, we rank our fourth and final category here, which is income stability. And you can see here, as expected, the 4% rule, if it can be executed as it's designed, would give you the greatest income stability. The problem is you can't execute it that well. So there's kind of some discounting factor, but it does win across these 4 metrics. And the worst in terms of income stability would be the glide path. And that's because in the glide path, studies have actually found that if you decrease your equity allocation over time and transfer that to bonds, you actually make your portfolio less and less sustainable over time, meaning you're more and more likely to run out of money as you age. And the guardrail strategy falls somewhere right below the 4% rule. In most cases, the guardrail strategy actually does have reasonably good income stability, but that strategy does rely on the fact that you would be willing to make sacrifices to your income, either up or down, based on how the market performs. So let's wind this video down and do a total ranking here. The overall ranking I'd give between these different withdrawal strategies is a combination between quantitative and qualitative factors. My opinion as a financial planner who does this day to day and understands the balance between ability to execute over long periods of time versus optimizing for the best financial outcome, I believe the guardrail strategy far and away takes the cake and is the #1 withdrawal strategy I have explored. It gives you the best balance of peace of mind, of quantitative and qualitative factors. It's easy to execute. It's easily defined. The second best of these four would be the 4% rule. Now, we could actually come up with other withdrawal strategies. There are other withdrawal strategies that I did not explore in this video, and they might actually get ranked in between guardrails and the 4% rule because they'd actually be easier to execute and more likely that you'd actually be able to do it over time. But for the purpose of this video, the 4% rule is the second one in this ranking. And then the third would be pro rata, and the fourth would be glide path. The third and fourth ones on this list are actually probably the most commonly used withdrawal strategies across the board for Americans. And this just shows what I said at the beginning, which is that actually most people are using completely inoperable withdrawal strategies because they're simple and easy to execute, when they should go move towards something that has a little more definition and some better boundaries, so to speak. And so hopefully, as I wind this video down, this video has effectively communicated how truly important choosing the right withdrawal strategy is for both financial and non-financial success in retirement. See, at the end of the day, there is no universally right withdrawal strategy, and clearly there are some inferior ones that shouldn't be considered. They just don't get the job done. But clearly there are others in this video, the 4% rule and guardrails, that get the job done, and it's just a matter of pairing the right strategy with your goals. Do you want to leave more legacy and sacrifice spending now? Do you want to spend more while you're young and alive and leave lower legacy, right? So that being said, if you'd like to learn more about how we help our clients choose the right withdrawal strategy for their needs, you can visit our website at www.thepeakfp.com. Thanks as always for your time and attention, and I'll see you in the next video.